In this new session, we're going to continue with Chapter 11, Tax and Deferred Tax. So if you turn kindly to page 149 in your notes, I'll explain to you how this works. Now, my plan over the next few minutes is something like this. I'll guide you through an important concept, a slightly advanced one, may not come up, but it's nice to cover it. We'll then pick up a past exam question with numbers on deferred tax. And then in the last few minutes of our session, I'll introduce to you something more on published accounts. So that's the plan. Turn therefore to page 149. The words mainly from the examiner, oh, by the way, in the fourth last line, can you make that IAS 11, not FRS? And then as you move down, this is the point I was going to explain. Is it a liability? The examiner will sometimes ask you. He's quite a conceptual examiner. Of course, 65% of the paper is going to be numbers, but the other 35% is going to be written. But those marks are sometimes hard to come by. You must be prepared to discuss. So here's an example of discussion. The main area of debate when providing for deferred tax is whether the provision meets the definition of a liability. A liability, of course, is something that you have to pay, and in this case, tax. If the provision is likely to crystallize, become solid, then it is a liability. However, if it will not crystallize in the foreseeable future, then arguably it is not a liability and should not be provided for. You will recall from the previous session that if you have more capital allowances than you have depreciation, because the depreciation is added back to accounting profit and the capital allowances are deducted, the taxable profit is lower, so the company enjoys a tax advantage. Of course, in time, that will become a disadvantage because the depreciation will overtake capital allowances. So the capital allowances will go lower and get lower and lower as time goes on. The depreciation, however, will overtake the capital allowances, causing the accounting profit, after adjustment to taxable profit, so the taxable profit on which the tax is based, that will be higher because the capital allowances are lower than the depreciation. So you're adding back more than you're deducting. What the examiner means by this paragraph, quite simply, is if you have future capital expenditure, you'll get future capital allowances. So even though it might look like depreciation is going to be bigger than capital allowances, in years to come, it'll reverse. In other words, the taxable profit will still be lower than accounting profit. Now, the reason why the international, can you make that IASB and IAS 12, please? There. The reason why the international accounting body doesn't accept that argument is that the directors could say to the accountant, oh yes, in the future we're going to spend all this money on capital expenditure, new assets, and thereby, when they're doing a forecast, they can claim plenty of future capital allowances, ensuring that it's always going to be bigger than depreciation. But obviously, if the directors then change their minds and say, well, we haven't got money to spend on capital expenditure, obviously that forecast becomes invalid. So rather than opening the accounts up to abuse and creative accounting by the directors, the international body has taken a very conservative view and said, nope, unless that actually has happened and you've spent that money, only then do you bring it into the accounts, to the calculations. Now, this and other points are made clear in Bow, a past exam question. Bow purchased an item of plant for $1 million on the 1st of October 2005. Please underline that date with me. It had an estimated life of 8 years and an estimated residual value, scrap value of $200,000. Now, going back to our time together on IAS 16 a few sessions ago, can I challenge you here and now to work out the depreciation? Stop the tape now. Give me a figure for depreciation kindly. Yep, you've got it. That figure, of course, 1 million minus 200,000 divided by 8 years is 100 per annum. 100,000 per annum. The plant is depreciated on a straight line basis, of course. Tax authorities say that the tax expense is 40%. That's another way of saying capital allowances on the cost of this type of asset can be claimed, and 20% per annum is depreciation. I beg your pardon, the 20% per annum on a reducing balance of this tax base thereafter. In other words, capital allowances in the future. Depreciation we've already worked out. So let's attack this question. I invite you to open up a nice new sheet as we solve this past exam question. It's a little bit difficult, or less easy, let's call it, but I'm sure we can do it together. Here we are. Question called Bow, page 149, to help you find it. Answer the question exactly as it's set. First bullet point, calculate the deferred tax charge or credit for the year and the deferred tax balance in the statement of financial position. So I intend to do the income statement for the year to 30th of September 2008, thousands. Let's do our usual CUD mnemonic, C-U-D. The total of all of that is that figure, and that goes to the income statement as a charge. Now, lower down the page, leaving a line so it's visually acceptable to the marker, who's probably marking quite fast. Let's say statement of financial position as at 30th of September 2008. And of course, we have non-current liabilities, deferred tax, opening, don't know, leave a gap. Income statement transfer, definitely don't know. And the closing balance, which I'm going to do through workings. I'd like you to abandon the rest of that page. We might bring in some journal entries, etc., to explain in due course. I invite you to move to the second page as we attempt some workings. So, page 2 of our solution. Bow workings. You must be absolutely certain as to what is in your main answer, submitting it for marking, and what is your backup workings. You mustn't mix the two up. Sometimes you have to, inevitably, but your general policy must be to keep them separate. You pass on your workings, but you also get marks for presentation in your main answer. The two must be kept separate. That is good exam policy. Thousands. Working 1 is an attempt at depreciation. Cost minus residual value divided by life. The cost, we were saying a moment or two ago, is 1,000 in thousands. Residual value is 200. The life is 8 years. And putting that together, we find ourselves with 800 divided by 8, or 100,000 per annum. First mark scored. Now, what I intend to do next is going to take about 3/4 of a page, so keep yourself plenty of room. Next is the summary schedule of the overall position. One of the secrets in using the stationery given to you by ACCA in the exam is to use the entire width of your page. If you remember when we did things like associates under consolidations, we insisted on leaving enough room. So let's attempt that as well here. Basically what I'm going to do is to have a 5-column approach. Some descriptions on the far left, the accounts net book value, and then the tax net book written down value next to each other, and the difference will be the temporary differences, as we saw earlier. So let's do exactly that. 5 columns should do the job. The accounts net book value, leave a good gap, kindly, before you come to the tax written down value. And then nearby, I'm going to say, therefore, temporary difference subjected to tax. At tax, 25% rate. So to be multiplied by 25% tax rate. So let's commence operations. Looking at the question carefully, we certainly bought, cost therefore, an asset of 1,000, and I'll put that 1,000 into there as well, leaving a bit of a gap. Less, for the year ended 30th of September 2006. Remember, you acquired it on the 1st of October 2005. The first year end is 12 months later. Please don't forget that. That is depreciation as worked out upstairs. You were saying it is 100. I'll deduct that. Let's concentrate on one thing at a time to eliminate error. That is the net book value. We'll then say less 2007 year-end depreciation. Of course, straight line is 100, giving us 800 net book value, less 2008 depreciation of another 100 to give us 700 net book value. Now allow me to move across to the tax depreciation, I should say, or capital allowances. I'll just keep the written down value column going. If you go back to the question, being very careful, the third last line of the main paragraph says 40%. So I'd like to charge 40% of that to give this. So that is 400. Clearly the written down value is 600, 120, of course, is 20% reducing balance basis of 600. 1/5, 600 divided by 5. Or use a calculator if you feel it's necessary. 480. 20% of that, which is, of course, the written down value. 20% of that, reducing balance. So maybe I'll just say red balance, reducing BAL method, is a figure of 96. And so 384 is how much we have. Now, what does all this mean? You have to use your imagination a little bit here. Basically, what we do is we look at our, let's say at the end of the first year, 2006, the net book value of 900 represents nothing but future depreciation. So if I say net book value is a plus, that represents future depreciation. So in the fullness of time, at the end of the first year, looking ahead at the future, 900 represents total depreciation. The 600 represents capital allowances. So I'll say minus, and this is nothing but capital allowances. Now, if in years to come, looking at the future as one big chunk of time, at the end of this year, looking at the future as one big chunk of time, the 900 represents future depreciation figures piled up. And that depreciation is going to be added back in tax computations in years to come. The capital allowances are deducted, so would you agree, in the fullness of time, looking at the future as one big chunk of time, there's going to be 900 added back and 600 deducted. Can I say it's a net add back of 300? That is the temporary difference. So I'll call that 300. And what was that tax rate again? 25%. And so the answer is 75. Come along, please, to considering the end of the next year. Plus, minus. What do those things mean? In the fullness of time, that represents depreciation being added back. And the minus, of course, represents capital allowances being deducted. So if you take the plus 800 and the minus 480, it is a plus of 320. At 25%, that is 80. When I say plus, what I mean is the taxable profit goes up, causing tax. So that's known as a temporary difference, the increase in the taxable profit, the 300 and the 320. And of course, if you consider that DT is CT on TD, the CT is 25% corporation tax on 300, which is 75, and 25% corporation tax on 320 is 80. So do you recognize that 80 represents the start of our current year? Absolutely crucial is to realize that this is our current year. This chunk of time, that year, those 12 months. So let's continue our process. This is a plus, this is a minus. So this equals 316. Obviously, times 25% equals 79. And those figures are crucial as we flick back to our earlier exercise and complete our question. So would you kindly come back, please, to the previous page where we laid out the CUD mnemonic. Here we are. The corporation tax, unknown in this question, under, stroke over, provision is not known, not relevant to this question. And then you have your deferred tax transfer, which, as you will recall from earlier exercises, is nothing but the figure that you work out from down here. So I'll just come down the page to consider the opening from the working schedule. C, working schedule, and that figure was 80 at the start of this year or the end of the previous year. And then the closing we worked out as 79, and so the difference represents 1 in brackets. That 1 is then shown here to complete the story. So if I can just do a little arrowhead to indicate that that is perfectly connected to the story down here. Occasionally the examiner will challenge you with a journal entry. So let's play safe and do something. Debit deferred tax. Deferred tax is a liability. If a liability goes down, a liability is a credit. If you want to reduce a credit, you debit it. And of course you credit the income statement. And that's the one. Basically you're writing back an unwanted provision to the income statement. Too much was provided last year. So I'll just work through that again. This has such a high chance of coming up. I've got to invest some time with you on this. Deferred tax, the opening balance is 80, credit. The closing is 80, and clearly the one ought to be a debit. And if you work down the page to the journal entry, this is the optional journal entry, JE for journal entry. You debit deferred tax to reduce it, and you credit income statement. So did we do that? Let's go back, have a look. Yes, indeed. Normally, the corporation tax, under provision, etc., are charges, they're debits. And clearly, if you have something in brackets, it'll be a credit. So the deferred tax transfer in the income statement, of course, is a credit item. Now, I shall keep the published accounts detail for the next session. What I'd like to do, just for a minute or two, to crystallize this idea in your mind, make it become solid, may I just run through that rather complicated-looking schedule to prove to you actually it's not that bad. So kindly turn to your workings page as I explain how this works. You have depreciation, cost of 1,000, residual value of 200. Obviously, the depreciable value is 800 divided by 8 years is 100 per annum. Nothing to that. Easy marks. You must score all the easy marks. This is a much cleverer idea, the summary schedule. So what I've done is I've left a bit of a gap between the accounting and the taxable view of things. So the accounting net book value, the tax written down value, so that you can put in little things like 40%, 20%, etc., explaining to the marker in the gap in between the two. On the far right, we'll have temporary differences, tax 25% or whatever the percent might be. This is not a tax paper, so the tax aspects of the financial reporting paper are very straightforward. Cost, 1,000, 1,000, no problem. You take away depreciation, 100, 100, 100 like that per annum, and then you do your capital allowances, whatever the examiner says. This is a past exam question, a slightly harder than average one, but I thought we'd do it to prepare you for that exam. 40%, and so you have 600 left, and so it goes. The crucial point I ought to make is the fact that net book value is nothing but future depreciation added up. So if I had depreciation in years and years and years to come, and I piled it all up, it'll be a big figure of 900 at the end of the first year. And obviously 600 at the end of the first year for capital allowances. In years to come, that depreciation will be added back in the tax computation. The capital allowances will be deducted. And because you're adding back more than you're deducting, it will cause more tax. The other really, really important point I mustn't forget to reiterate is that 80 represents the end of the previous year. Remember, by the time we come to the year 2008, we are actually standing in the third year. At the end of the second year, we have a closing balance, which becomes our opening balance, of 80. And of course, at the end of this year, that 80 becomes only 79. Quite small, those numbers, the differences. So if you have an opening balance of 80 and a closing balance of 79, you have one extra thousand, which you transfer back to the income statement. And that is how deferred tax works. Absolutely straightforward. Though I still think that if you spend a bit of time going back to rereading those paragraphs I've given you, partly from me, but more importantly from the examiner writes beautifully. His expression is enjoyable, to be honest with you. I really enjoy reading his answers. His written questions are particularly good. So if you just go back and reread those points, you should glean a lot from this particular topic. Thank you.